Hello, everybody. Welcome to Chloethedev Unfiltered. We're going to be continuing with the paper review of the ETH2 Economic Review. I've gone through chapters 1 to 7 already, so the executive summary, introduction, background, and so on. I got some laundry in right now, so hopefully I'm just going to go for about probably 45 minutes to an hour, and then pop over to do that. So chapter 8 for today is going to be a model for measuring required yield. And yeah, so it's not that long, about 10 pages, and we're going to get started. So we're starting at page 45. Took me a while to actually get started, but I'm glad that I've been doing these videos, so now I can get into these papers more often. So, a model for measuring required yield. I'm going to make this a bit bigger actually before I get started. You can see it. There we go. As we outlined in section 4, security in ETH2 is highly dependent on ETH staked, which itself will be a function of yields. This is particularly important to attract long-term holders, which positively affects velocity of money. In this section, we explore a model for evaluating necessary yields to incentivize validator participation. Background. The objective of any incentive program or mechanism is to reward a participant or group of participants for behavior that is beneficial to a network or organization. In the case of ETH2, the network's security. Incentive program productivity is typically driven by a monetary incentive, but validator motivations in ETH2 are likely to be more nuanced. I would assume this is because your money's locked up for a couple years. For instance, yield-insensitive enthusiasts or long-time crypto holders might spin up a validator environment as a hobby, like me, for example, or out of a sense of duty, again, like me. For other incentive programs like sales commission structures, it's not often someone sells a product service as a hobby. So in ETH2, a lot of times, a lot of people might just run at least one validator just because either they just love the network, want to help out, or also because they feel like because they use the network, they want to also try and secure the network, and that's their duty as someone as part of the community. So I feel like I'm part of both of those camps, and I will run one validator at least, regardless of how long my funds might be locked up economically. For this reason, we segment the profiles of validators into two types: capital efficient participants that desire a return on investment net of risk, and partakers that are apathetic to yields. I'd say I'm like in the middle of these two camps. For my I want to have a personal validator one day that is just completely altruistic, like just research validator node. And then I would like to have like the Marma J Foundation, where it's like, okay, well, it's our duty, but sorry, my back. Ooh, lots of good cracks. It's our duty, but I would like the foundation not to lose money, to be economically viable, and so forth. For the latter, there could be non-monetary motivational factors driving participation, such as the health and decentralization of the network, but attempting to measure these motivating factors into a desired yield would be arbitrary. Importantly, yield apathetic validators are also limited in number. I do agree with this whole limited number part, but that number is variable. So for example, if you grow the amount of people that love Ethereum because they want to support the network, because of what it can do for their communities, then potentially you can grow this number of yield apathetic validators. Also, I do agree with the stance that for a paper, though, it's most important to look at what the majority of people will be probably, and that's probably going to be validators who are capital efficient, and if it becomes capital inefficient to run a validator, they will probably try and find a way to no longer do so. The most stringent and yield sensitive participants in the validator pool are capital efficient investors who weigh risk reward ratios and serve as a more predictable foundation of contributors to network security. So there's two parts there. First of all, they're stringent on the protocol. How much yield am I getting? How much yield am I not getting? Am I going to leave? But they're also, it's easy to predict what they're going to do based on those yields and the network conditions. And so therefore it's easy to predict what that large subset of validators is going to do in terms of network security. The incentive mechanism will need to support yield-sensitive validators when yield-apathetic validators hit their capacity. So I'd say one of my goals is to continue to increase that number of yield-apathetic validators so that, you know, the capacity will take longer to hit. In this section, we formulate a model called the RSAVI, the Required Serenity Active Validator Yield. That's what they call it, RSAVI, because it's a long name, to assess the required rate of return for yield-sensitive validators. We note, given the nuances above, this model only applies when the calculated rate of return falls below the resulting yield derived by the full participation of yield-insensitive validators. And then they have Exhibit 29 to explain all that. Perfect, Exhibit 29. So applying the model measuring the network's required yield. So you have the network ETH staked on the left. You have the maximum ETH staked from yield apathetic validators. So once we hit that threshold, and then you have this incremental ETH staked from capital efficient validators. What I would hope to see though is less of a threshold and more of both of these two camps increasing. And it would be really cool to see this maximum ETH staked from yield apathetic validators threshold be this base that grows the base security of the Ethereum network. Like knowing that, for example, we know that 50% of the network is yield apathetic, so they're going to run nodes and run security for the network regardless of yield. Therefore, capital efficient validators might feel more secure validating, knowing that there's a large subset of people who are running nodes regardless. I think that's going to be very interesting to see what happens in that sense in ETH2 when it launches. Defining the types of validators. Validators can come in all shapes and sizes, but for the purpose of structuring a required return model, we define validators as either capital efficient or yield apathetic. Exhibit 30. Then you have, crypto enthusiasts, crypto holders, and then capital efficient is like people who are managing, billions of dollars. So, as a crypto enthusiast, I'm, say personally, the Marma J Foundation, we might one day, manage $100,000 in assets, $1 million in assets, even a few $1 million in assets would be wonderful. But this camp over here, now they could be managing billions in hedge funds or pension funds, and if they're doing some sort of, validating through a third-party service and the yield goes down, we'll be like, okay, well, we're not doing that anymore. And so that's kind of the reason why this camp needs to be as large as possible, but what's really important for assessing network security is really the capital efficient camp. And then what their motivation is below. The total investment from yield apathetic validators is limited in size, but measuring this threshold is difficult. For context, there are currently approximately 700,000 Ethereum wallets that hold more than 32 ETH, see Exhibit 31, with an average of 886 ETH per wallet. I wish I could spin up that many validators. Subtracting 18.7 million ETH from exchange wallets, 86.6 million ETH, or 77.7% of total ETH supply is in staking qualified wallets. For example, we assume a 10% share of staking qualified wallets stake their ETH. The total amounts to 8.7 million ETH staked in the network, or 7.8% of the network in total. Also you're going to get validator pools or fractionalized validator environments, yes, and they could expand this addressable market and potentially and then yield apathetic participants. However, in any case, the arbitrary motivations of this group of validators and the resulting unpredictability on the total ETH staked should not be relied upon. So this is what I'm saying, this group of people is very important, they're great, it's a great large group of people, but relying on that for network security, with probability and mathematics, probably isn't a great idea. So, in other words, for the most secure and stable network, the incentive program should be designed for an objective and predictable group of validators. Because if you can get all the hedge funds on board, then you know that that amount should be way larger than the altruistic group of validators, or yield apathetic participants. So in that case, you could actually also if you create your platform to have a yield system that's good, that's which makes capital efficient validators happy, then definitely yield apathetic validators will be like, yeah, cool, I'm making money, that's awesome. And that's the goal of the Mama J Foundation, to be in this camp of yield apathetic, but also be making money because the network is capital efficient, is a great place to be. Then you can just have your network, not really care about how much money you're making, and still go and support other people. So that's kind of like the cool idea of all this. So the size of the pool of qualified wallets holding over 32 ETH is certainly and compellingly sufficient, but focus should be on growing the validator share of this qualified pool. So, Exhibit 31, the number of Ethereum wallets with more than 32 ETH. So it looks like over time, it's grown considerably with the number of wallets, which is really cool to see. Because arguably, that should mean that it's not just a bunch of Ethereum OGs that have the money, but it's more and more people who are actually having that amount. It could just be a bunch of people splitting up their wallets, but you hope some of that it's not that. We envision individual interest in validating to grow if the economics are lucrative. Makes sense. Supporting the design goal of network decentralization. We aim to further understand the motivations behind this profile of validator. So we're digging into this capital efficient validator. Potential motivations. As noted previously, we do not believe that the capital efficient validator is a substitute definition of institutional validator. Okay. However, the motivations of institutional investors will undoubtedly reflect similar motivations to most capital efficient individuals. Understanding the investment characteristics of staking from the purview of institutional investors will provide a useful proxy for the investment characteristics of capital efficient investors. So now I think they're taking this shift and looking at, okay, well, capital efficient investors and institutional investors are kind of looking for the similar things. They're not the same, but they're similar. So looking at it from the institutional investment point, which is the most stringent, will, I would assume, give us the similar profile of capital efficient individuals. Make sense? We interviewed 4 stakeholders in the crypto and blockchain industry who are institutional investors or serve institutional stakeholders with custody, trading, and or digital asset research. A digital asset analyst from a leading financial institution indicated that their clients' interest in digital assets is driven by the following. Very interesting stuff here, I suppose. Crypto is an asset that has historically been uncorrelated with any other asset class. See Exhibit 32. According to Fidelity Digital Assets, 80% of the survey of institutional investors find something appealing about digital assets. With the most significant reason, 36% of the respondents, being their property as an uncorrelated asset. According to modern portfolio theory, an uncorrelated asset lowers portfolio risk. This would in turn increase portfolio Sharpe ratios, or risk-adjusted returns. So that's just saying a lot of people simply want to throw a chunk of money into crypto because it's uncorrelated with what other assets they have. So if you're really rich and you have like $1 billion and 90% of your money, also 900 million is in traditional assets like land, real estate, businesses, stocks, all bonds, all that kind of stuff. They want to make sure that they have some crypto, because if the traditional market is falling and crypto's not correlated, so it's not doing the same things, crypto might stay stable when the stock market's falling, so which means there's less risk in that profile. And as well, if the stock market's going up, that might mean uncorrelated, the crypto market might go down, but as well, if what you're looking for is to reduce some of the risk of your profile, it might make sense to do stuff like this. So in crypto, what I enjoy is that the ability to do this comes from like some LPing on Uniswap from a stable coin to some asset you want to hold, you might think might go up. So for example, the Marma J Foundation LPs for Uni and ETH. In my opinion, I consider ETH to be the stable currency, and Uni to be this arbitrary currency that might go up in value because of whatever. And so, even if ETH goes up instead or Uni goes up instead, the idea is instead of holding simply this, riskier asset class, you could hold something that potentially won't correlate. So the better idea would be, USD to Uni or USD to ETH, having something that's stable and then doesn't correlate. But it kind of depends what you consider to be some sort of stable asset, I guess, in that sense. An investment in digital assets will be viewed as managed similarly to a venture capital investment, where high usage of the network and or its narrative will support a higher asset price. They either see the investment going to zero or having asymmetrical upside. I definitely see this part when I was a full-time trader. That's definitely the way something was looked at. It's like yeah, like when you hold something, that's potentially a risky asset class. If the network's not, like, in my opinion, potentially, if the network's not being used, it potentially could go to zero at any point in time. And I know there's other assets where, like, Litecoin, where there's enough liquidity where it's a bit different. But for most assets, if there's no network surrounding it, pretty much going to zero, potentially. There's always that potential. And so that risk in your institutional profile isn't really worth having. And I guess there's other pages you can look into to see all the details. And this is the correlation of the stock market and gold and treasuries and all that, and the volatility index and all that, and how it correlates to crypto. And as you can see, it's, I guess one being the most uncorrelated, because I guess Bitcoin would be the standard on that. And then you see all the other coins and how uncorrelated they are. And it's pretty crazy. I mean, how you look at it right there, it's, uncorrelated crypto in general. The most correlated is probably Ethereum Classic and Bitcoin Cash, but even in that sense, yeah, not really. Cool. Yeah, I wonder where this data came from. I'm gonna have to have some fun with that. Anyways, as confirmed by our stakeholder interviews, we assume it is easier for the average institutional investor, and we believe it is non-controversial to assume the same for retail investors, to familiarize themselves with the narrative of Bitcoin than that of Ethereum. Bitcoin serves as the gateway asset to the crypto landscape and has become the benchmark digital asset. Makes sense. Despite the different narratives, Bitcoin and Ether are still highly correlated. And I think that correlation is definitely going to separate a little bit, or more and more over time, as these market caps of the two, assets grow. I think right now a lot of the whales, or the people who hold a lot of both of those coins, they're having a lot of fun trading the charts and the correlated charts and non-correlation in the stock market and the stable coins. I think that once value grows large enough on either of the two chains, I think that correlation is impossible to continue with, just because the use case for Bitcoin and the use case for ETH, in my opinion, are quite different, to be honest. And so if, for example, the Bitcoin market cap goes up 10x from here, that use case is good, then apparently solidified, where Ethereum, in my opinion, has not solidified that use case, because its use case is completely different. Whereas, if the Beacon chain comes out and ETH gets staked and ETH, phase 1 comes out in like 6 months and it's going crazy, then I think, ETH might go 10x or, do well. And then, but that doesn't mean Bitcoin will have its, correlated in that well either. So, but I do see how Bitcoin and ETH are highly correlated, to a certain extent. Makes sense. Why is interest in Bitcoin important with regards to potential motivations for staking of capital-efficient investors? This group of potential validators will always compare the alternative and explore opportunity costs. Makes sense. So this is saying if people are getting into crypto and getting into Bitcoin and they see, I'm already in crypto and I can go stake here and earn 15%. Okay, well, ETH is correlated similarly to Bitcoin, and I want to get into crypto to be uncorrelated from the stock market. Why not do this thing as well? So let's put 10% of my wealth into Bitcoin, and then maybe 3% into ETH, and gain some income on that as well. This group, so according to Fidelity Digital Asset Survey, 91% of institutional investors surveyed are interested in exposure to digital assets and expect to allocate on average, so I'm using numbers like 5%, 10%, whatever, but on average, 0.5% of their portfolio to digital assets over the next 5 years. And that is a lot of money for these people, okay? I know for me, I'm 100% in crypto, and it's like, I don't even make a dent. But these people, their 0.5% is a large amount. So what you've got to understand is if you know what that 0.5% is, and you know that this is coming into crypto in general, and let's say 80%, 70% goes to Bitcoin, but 40% has to go somewhere else. Let's say 30% of that goes to Ethereum. Okay, well, if Ethereum is capital efficient, then how much funds, how much ETH is that's going to be providing network security? And that's what you can kind of start digging into. Reverting back to modern portfolio theory and Exhibit 32, digital assets are correlated with each other, but uncorrelated with any other traditional asset class. When assessing allocating some of their 0.5% of the digital asset portfolio designation, capital efficient investors are likely to default to the easiest to grasp Bitcoin narrative as the benchmark when comparing opportunity cost. The investment narrative then shifts from Ether versus Bitcoin to Ether plus staking versus Bitcoin. So now, the narrative currently is like, okay, well, do I go for Ether or Bitcoin? Ether I don't understand. Bitcoin I understand. Let's go with Bitcoin. Where now it's like, ETH has this staking thing, like I said. So now you're not only investing in ETH, you're investing in ETHing plus this yield, which might pull more of that institutional investor money away from Bitcoin and into ETH to like staking. This might make the return on investment more compelling, but it depends on the risk, and this is the very important part. And I think Rocket Pool and certain derivatives that allow investors to sell some of that return to negate a lot of that risk will be very important, i.e. standard deviations according to Sharpe ratio of Ether versus Bitcoin, as well as risks and costs of staking. We quantify these risks in the required Serenity Active Validator Yield model, the R-Savvy model. I keep using this. So the R-Savvy model based on the variables that impact efficient validators' yield expectations, we introduced the R-Savvy model, a multivariable capital asset pricing model for determining the required rate of return for capital efficient validators. The R-Savvy model is a risk-weighted pricing formula that takes into account the following return requirements and risk factors: the opportunity cost of allowing capital to a risk-free rate, allocating capital to a risk-free rate, the cost of illiquidity of ETH2, very big cost, the opportunity cost of investing in the underlying asset's benchmark, the opportunity cost of lending the asset, the discount premium of the derivative asset, so that's kind of like the NETH that you might be getting from validating on Rocket Pool, like I have above. The cost of validating, so for example, right now I have my Mac Mini on at all times. I have, my internet running, so all the costs there. The cost of penalties, so if you're offline for too long, an activity leak or slashing, and the cost of being slashed. Expressed mathematically, we obtain, and this is where math comes in handy, and my brain, to sit there and have fun doing all that, it doesn't sound like fun right now. But if you want to sit there and go through it, you could have fun. So the revenue yield of a validator is going to equal the risk-free rate plus the cost of illiquidity at time t, i.e. the spread at end of an investment, where PA is the price of the ask and PB is the price at bid time t, which is divided by the maximum of 1 or the expected holding period in years. dude, I mean, yeah, you're just going into all this cost, and this is how you would try and tell an institutional investor to put their money into something. Okay. Again, you just dig into it, you plug all these numbers in, and you come up with some probability of knowing what your risk is and what your revenue is, and if it's worth validating. We note this structure is driven by several assumptions. Yes. The R-Savvy model assumes risk of the platform from an ongoing concern basis is factored into the beta of the underlying asset's required return, or the opportunity cost of investing in the benchmark. Okay, so I am going to go through these numbers, these definitions, because I think while going through the equation isn't necessarily, it is important, but it takes a lot of time. I think knowing what variables are being used to come up with this revenue yield is important. Okay, so here's your beta of the returns of the staked asset and its benchmark, for example, Bitcoin and Ether respectively, -1 to account for the difference in volatility risk between the assets. Okay, so, obviously, yeah. Okay, anyways, just keep going. This is the expected return of underlying asset benchmark, so for example, Bitcoin. This is the cost of illiquidity of the asset benchmark at time t. Again, it's kind of hard to know a lot of these things until we actually get a running network and we can see what these things are. The discount is a negative value, or the premium, which would be a positive value, of the derivative. I doubt there'll be a premium on the derivative, but if applicable, yeah. So there's probably going to be quite a big discount, I would assume. The yield beta of returns of lending opportunity costs, such as the DeFi benchmark, against average network validator net returns. Yield beta is the scope of a plot of the benchmark's yields and the underlying assets yields. I'm assuming this is talking about if you have like 100 ETH, let's say, and you staked it versus how much funds you would make just from lending out on some platform like Compound Finance or Yield Finance or Unity, whatever. There could be DeFi yields, or you could lend it out on some platform, or you could stake, and so there's this difference there. This is the expected return on DeFi benchmark, the cost of validating, the weight of expected penalties of a validator environment over the expected penalties of the network per validator per time t. Very interesting. So now you're comparing yourself to the rest of the network. The penalty spread, or total network penalties, is a percentage of total ETH staked. The weight of expected slashing amount of a validator environment divided by the expected slashing amount of the network per validator during time t. Again, comparing your own validator slashing, expected slashing. Hopefully none. I think on the thing it said one slashing per year. So I can't remember the ghost paper. I think it was the ghost paper I was talking about. The slashing spread, or total network slashing penalties, is a percentage of total ETH staked, and the alpha of validator. And so those are all the variables that go into the R-Savvy model for figuring the revenue yield of a validator. We note that this structure is driven by several assumptions. The R-Savvy model assumes risk. Okay, we already went through that. The model also assumes the asset purchased to stake and validate is only one asset, for now ETH, which, oops, I didn't go through this part. Yeah. For example, consistently higher levels of volatility relative, actually I did go through that part, would indicate idiocentric risk of the asset. Okay, so we went through this part, which given the rate of innovation of the decentralized finance industry could be subject to change. Very interesting, that point there. Furthermore, the model assumes the underlying asset's benchmark has a stable level of correlation with the asset itself. If the benchmark and the underlying asset become negatively correlated due to decoupling narrative and a beta approaches 0 or below, the model indicates a new benchmark with a relatively higher correlation should be applied instead. Okay. Lastly, we note that the required rate of return is from the investor's perspective. An investor might access the yield through an intermediary, such as a centralized exchange product or a tokenized ETH2 instrument. So it doesn't have to be them staking, it can just be whatever rate of return they're expecting from whatever derivative of ETH2 investment they come across. The discount premium of a derivative is a variable of the R-Savvy model applicable only if the capital provider's method of gaining access to validating yields is through a derivative instance. So they're saying that this variable would only be added if you were staking on something like Rocket Pool getting an ETH, or you were staking on some other service that was giving you some ETH2 derivative. But if you were staking just by yourself and not getting any derivatives, then obviously you couldn't add that into that variable to the equation because it wouldn't be there. Or you could, but it wouldn't add any value. The R-Savvy model does, however, account for many shifting variables of the network, including the change in the underlying asset's benchmark and its lending return benchmark. An alternative to the process of validating is lending the asset on a protocol-driven finance platform for variable yield. It is important to note if there is more demand in these networks, which there likely will be if the arbitrage opportunity of DeFi staking is considerable, DeFi yields would increase, which I'm excited for. So this is really cool. So like DeFi yields are going to increase for ETH because of ETH2 as well. Because of the opportunity, like there's opportunity cost to holding ETH. So someone's gonna be like, hey, I'll pay you to borrow your ETH and then lend it or then stake it and get some return and get some derivatives, sell those derivatives and pay back the loan. So DeFi yields are going to increase as well, and DeFi yields get kind of complex, and so potentially this DeFi yield could be above the staking yield. This could indicate a potential shift in capital to the highest risk-adjusted yield, as has been investigated previously by Tarun Chintra. In this case, as well as the case of the other benchmarking variables, beta captures the relevance of this event in the future. Given the network has not launched yet, and we do not have data to support a statistically significant conclusion, the model is structured to support future hypotheses. So you got to have obviously these beta values that are not actually real values yet because the network isn't launched. Currently with Madasha, I would love to see a new paper out about that, but I would assume it would be difficult because again, in Madasha, the investors or the stakers are not capitally efficient. They're just people who want to help out. And so what I think would be more important is a paper that comes out like directly as the Beacon Chain launches, talking about Madasha and maybe trying to, or like maybe not exactly, but maybe a month or so after the Beacon Chain launches, because assuming it might take more than a month for the network to start. Just kind of talking about Madasha, the differences of the Beacon Chain with real capital on testnet, on the mainnet, and then talking about what we might see with those differences as we go into a live Beacon Chain. But okay, beta is a measure of volatility and price movement relative to a benchmark. If the average daily returns of DeFi yields are significantly more volatile than the daily returns of validating, then beta will be less than 1, making the DeFi yields variable less relevant and impactful to expected return. Beta can only apply to the variables with returns. For comparing penalties or slashes against a benchmark, i.e. the network, we calculate the amount of stake impacted by expected events against the network average. If a staking as a service STAS, if a STAS provider's penalty rate is greater than the network average, i.e. the benchmark, the expected variability of the validator environment should be greater than 1 multiplied by the network's average cost of penalties, reflecting the appropriate benchmark-driven risk adjustment of penalties in the validator's expected Return. A lot of words just saying that how they are benchmarking between the network slashing or penalties and a specific validator's expected slashings or penalties, and then how you would put that into the equation. I'm gonna have some water because my throat hurts. I think Bianca and I are gonna have Thai food tonight, date night. We sometimes do pizza, like oven 360. We love it. It's a flat, a thin crust. I love it. But I think Saigon House locally has some great Thai food, and so I think we're going with Thai, some vegetarian Thai with tofu, and some fresh rolls for date night. So, anyways, applying the R-study model to phase 0. Applying the R-study model will illustrate the sensitivities of each variable during the required rate of returns for validators. As mentioned, we do not have historical data to accurately measure the degree of significance of each variable, but we can make calculated assumptions. To effectively measure sensitivities, we make both a bear implies fewer validators and lower security, and a bull implies more validators and higher security case for each variable. Then you have this wonderful chart, which is talking about the different variables, the component of that variable, the bear case value and the bull case value. So these are the values that they used, and then when they come up with it, the alpha, I guess, is 0 anyways. Calculated cost of slashing, like some of them are 0. But anyways, in the bear case, your expected revenue could be around 11%, and your bull case would be around 3%, which is quite low. So, and your DeFi yields are already showing above 3%. And then, 11% seems kind of cool because it's a stable rate, remember, or relatively stable. So yeah, risk-free rate. At the time of writing, 10-year treasuries are yielding all-time lows of 0.685%. Over the past 5 years, the 10-year has averaged around 2.25%, making an assumption below 2% would indicate we do not see inflation of the U.S. economy reaching prior levels. Hence, we use a non-controversial assumption of a 2% risk-free rate for both cases. So it's explaining why they use certain rates up here, and we're gonna go through all of them and explain how the numbers were derived. So the cost of illiquidity of ETH2. This variable is dependent on innovation and adoption in the market. As noted in phase 0, assets on the beacon chain cannot be withdrawn. The protocol has a required lockup period until phase 2, resulting in 0 liquidity for an undefined period of time. However, centralized exchanges with SaaS offerings as well as fund managers may offer trading of ETH2 as either a tokenized ETH1 asset or centrally within their platforms. I think both these are definitely going to happen. While this is anti-productive for decentralization, it does drastically reduce the risk associated with the time until the lockup period ends. In assessing the liquidity of such an asset, we consider ETH, which is currently a generally liquid asset with an average a total trading volume of 16 billion per day. Woohoo! Year to date. And trades with de minimis bid-ask spread. So basically, the bid-ask spread is very, very, very tight and has a huge amount of volume. For Beacon Chain ETH, i.e. ETH2, in phase 0, we will assume a similar spread in the bull case, indicating a successful production of Beacon Chain ETH derivative markets. We assume a 1% spread in bear case, which I think would be insane. Even just putting RETH and ETH on Uniswap, a 1% spread would be ludicrous, indicating some success in liquidity markets but lighter adoption. Yeah, I think that instantly the RETH market is going to be insane. I mean, personally, I plan to run at least one validator with 16 ETH, and then I plan to deposit personal funds on my personal account of ETH into RETH, so that I can have a validator running and provide some liquidity LPing RETH and ETH. Opportunity cost of investing in benchmark. As stated above, investors are primarily interested in the crypto asset class for its attribute of being uncorrelated with any traditional asset class. This investment narrative is comprehensible for institutional investment committees because it supports a reduction in portfolio risk. Bitcoin is the largest and most comprehensible asset in the digital asset industry. If institutional investors are interested in diversifying their crypto asset allocation, they will logically use Bitcoin as the benchmark for this purpose. We analyzed the historical pricing data of ETH and BTC and calculated a median beta of 1. See Exhibit 34. The asset returns of Beacon Chain ETH may be more volatile given potentially higher illiquidity and infancy of the protocol in general. We assume a 1 beta in the bull case and a 1.2 beta in the bear case. Bitcoin, with 38.3 billion in average trading volume per day, cool, also has a minims cost of illiquidity. So the spread's very tight. We use a venture capital's minimum required rate of return of 20% for Bitcoin's expected return. The time plot, last 12 months beta of ETH and BTC. So highly correlated, it seems. The premium discount of the derivative asset during phase 0 and phase 1, when withdrawal and transferability of Beacon Chain ETH is not yet enabled, as noted above, centralized exchanges and funds may offer derivative assets which trade separately from actual ETH1. From the individual capital provider's perspective, the discount or premium of the derivative asset should be factored into the risk-reward assessment. Theoretically, because the enablement of transferability, thus liquidity, of ETH2 assets is anticipated to come at a later unknown date, ETH2 assets essentially mirrors a futures contract. The pricing of ETH2 assets is a function of the sum of discounted cash flows, net of expenses, from the purchase date until the expected liquid date, offset by the discount of the ETH2 asset, accounting for the time and execution risk of the network not going live. So basically, the price of ETH2 is going to be, could be, I guess, well, it'd be hard for it to be higher than ETH, I guess, by much, unless you get closer and closer to ETH2. But the idea is saying that you just got to balance out the risk of like ETH2 not going live or ETH2 not coming for a long time, and like subtract that, I guess, from the price of ETH, and you should be able to provide some sort of discount. For simplicity, because this is impractical to predict before launch, agreed, we assume these factors offset each other. For example, a decrease in yields is likely indicates an increase in network confidence, meaning decrease in risk in ETH2 going live, and vice versa. So if your yields are going up too high, it's probably not a good thing. Probably there's not much confidence in the network going live because people are afraid of staking. As people stake more, yields will come down. That probably means there's more security and people think the network's going to go live. There's going to be a higher probably derivative price and so on. For this reason, in both the bear and bull case, we set this metric to 0. We encourage validators to change this parameter post-launch when evaluating yields. So it'll obviously be set to some sort of negative, in my opinion. But that negative percent should lower and lower, get closer to 0 as Beacon Chain gets closer to launch. And who knows, as we get really close to like phase 2 launch or phase launches, those derivatives might go above the price of ETH because it'll be harder and harder. It takes 2 weeks to get your validator running, and so in the 2-week launch up to ETH2 phase 2 years from now, I'm sure it'll be interesting to see how that the beta changes. The opportunity cost of lending. The opportunity of lending ETH on a DeFi platform in lieu of staking presents alternatives to spam callers. Alternatives to yield-seeking investors. It comes as an additional term in the R-Savvy formula to the benchmark opportunity cost, as investors who decide to invest in ETH must then consider the opportunity cost between different forms of productivity allocating their capital. Different forms of productively allocating their capital. Currently, Compound, the most liquid DeFi protocol at time of writing with $65 million of liquid supply, has offered a yield consistently below 10 bips over the past year. In both bull and bear cases, we assume a yield beta of 1, assuming high correlation and similar risk profiles. We envision demand for borrowing ETH will increase with opportunities to arbitrage validator yields. That said, we considerably use a benchmark return in line with the past 12 months of month high of 10 basis points for the bull case and 2% for the bear case. I think it's impossible to measure a lot of these things until it comes out. Yields are going to keep getting crazier and crazier. People are finding cool new ways to find yield on Ethereum and in blockchains and pull yield from different chains. So I think it's going to be very interesting to see. But I think that ETH2 will be seen as more of a less risky avenue for return than a lot of these higher yield platforms. The cost of validating, leveraging our model in calculating revenue net yield spreads, we assume a network average cost of validating yield out of approximately 1% for the bull case and 2% for the bear case. The cost of penalties for both bull case and bear, for both base and bull cases, we assume an average validator indicating a weight of expected penalties of 1. And an assumption of 89% of validators online and working consistent with network protocol. We estimate network penalties to range from approximately 4 basis points to 34 basis points of total ETH staked. This level of network penalties assumes validator clients will be functioning properly without delay concerns and validators are online attesting and proposing blocks. We consider 0.19% the midpoint for the bull case. With 90% of validators assumed online, network penalties as a percentage of totally staked increase to a range of 0.2 to 1.8%, with a midpoint of 1%, which we use as the assumption for the bear case. So just again, how they came up with these numbers they used. The cost of being slashed. A capital efficient validator would want to weigh the risk of being slashed, which can occur for both dishonest validators and intentionally honest validators. What? Oh, like yeah, if you make a mistake or yeah, if someone hacks you. Client bug risk or relying fully on third-party clients, such as fully delegated SaaS infrastructure. That's why with Rocket Pool, I enjoy it from what I understand. I'm running my own ETH1 node, I'm running my own ETH2 node, and I'm running some software, but I'm running software on my own as of a watchtower because things are going well. And I have, I share penalties and slashings with the network, I suppose. At the same time, I share rewards as well, and so I'm kind of, if I would receive some penalties, I don't have to deal with that as well, or as strongly potentially. We assume the expected weight of slashing to be 0 for both the bull and bear case, implying a validator's full trust in its end-to-end architecture. So I'm trusting Rocket Pool apparently. It is open source, so that does help. To estimate total network slashings in ETH as a percentage of total network rewards, anecdotally, assuming one slashing event per 1,000 epochs would result in a 0.8 basis point slashing spread. So there you go. So Exhibit 35, summary of assumptions for bull and bear case. Again, just going through liquidity, volatility, opportunity cost of letting, risk of validating, and risk of penalties slashing, which we just went through. Conclusion of our Savvy application to phase 0. We derive an expected return revenue yield using the R Savvy model of 11.6 for the bear case and 3.3 for the bull case, using an alpha of 0. So that's just saying that in a bear case, institutional investors should, economically rational investors should expect a return of, or will expect a return of 11.6%. And in a bull case where a lot of people are validating and things are going well, and the price of ETH is high and everything's going well, expecting 3.3%, which I think is low, but reasonable in the case of like long-term bonds and ETH being an uncorrelated asset and what was talked about above. The difference of these results is significant despite the small differences in input assumptions across cases. Comparatively, the bull case results exhibit similar yields to lending and a mortgage to a low-risk borrower, while the bear case matches up to a high yield, high risk corporate debt instrument. In both cases, A semi-liquid secondary market supported by high functional client and consistently online network are assumed. Higher network costs and an increase in underlying asset variability and in reinvigoration of ETH borrowing, driving higher DeFi yields for arbitrage will call for a higher required return. And this is where I think kind of we're trying to understand what should the inflation rate of ETH be. And I think it's hard to know what it should be. And I think it should be higher than needed at the beginning. Obviously, you pay up for that security at the beginning because it could always come down later. At the same time, these derivatives might really start increasing their yield at the same time. Increasing the yield on ETH2 might just go increase the yield on these derivatives, which would be backwards. Takeaways. In summer, we expect the total pool of yield apathetic validators to be limited in size. Concurrently, capital efficient validators are motivated primarily by economic factors. That makes sense. In other words, capital efficient investors require a certain rate of return to invest their capital in staking versus allocating capital in other ways. Based on our results, we expect an optimized network yield, which we use approximately for a minimum yield of 3.3% for these validators to invest. So if it's below 3.3%, capital efficient validators probably won't even be interested at all. Under a more bearish yet stable scenario, this yield requirement goes up to 11.6%. So again, we're saying that if the yield is at least 11.6%, even in the bear case, capital efficient investors should still want to be staking and validating the network. This required rate of return takes into account several parameters in addition to the usual RRR formula, including the cost of illiquidity, the cost of validating, the cost of penalties and slashings, as well as the opportunity cost of validating because your ETH is locked up and you can do something else with it. Given a RRR range between 3.3 and 11.6%, this suggests that once a threshold of ETH staked is reached and yields decrease, the return on staking will no longer be attractive for yield-sensitive investors. This is an important part. The question this leads to is whether that threshold is at a high enough rate of ETH staked to provide sufficient guarantees around the security of the system. To understand this, we look at different economic attack vectors which enable us to find a required ETH staked rate. So we've gotten through a kind of a good part now. I think it's pretty cool now we understand okay, so we have all these people there. Yes, they're going to stake. And so the beacon chain, the whole ETH2 chain might just launch based on altruistic people, yield apathetic people, but that will not secure the network for a global infrastructure. To have that, you need to make sure that capital efficient investors are also going to be investing in this. This is a long-term investment they have to make. So with the amount of investment that might come into ETH and the level of the price of ETH and the security that's going to be attained at that price, is that enough security for what ETH2 wants at that time? And I think that's the whole idea of trade-offs. Because you could increase the rate of return and increase inflation, which would increase security, but then potentially lower the cost or the price of ETH, which could then lower security. And so you got to find these balances for where these trade-offs are. So this weekend, I'm not going to have time tomorrow. My mom's coming to visit. We're going golfing and whatever. But Sunday, if I have time, I'll try to get chapter 9. If not, I'll get through it on Monday. It is time to get laundry. This has been 53 minutes. Laundry is ready. I hope everyone has a wonderful day. Thank you for maybe watching. And yeah, if you want to go through the paper, we're almost done. Finally, we're on page 56 out of 101, but a lot of that's just the bibliography and references. But yeah, hope you have a wonderful day.